So ladies and gentlemen, welcome back to another video. My name is Waqar Asim from WWA Trading, and today will be a first video in a multi-part series where I kind of want to take you guys on the evolution with us, and the multi-part series being what is Wyckoff theory. So this is actually designed to be a prerequisite for future students coming on into the bootcamp to bring everybody to the same level or have that foundationary level of what is Wyckoff theory before we go deeper into our concepts in the bootcamp and how we apply it correctly, etc. So yeah, this will be an introductory point. This video specifically is a general outlook on what is Wyckoff theory, and then as the videos progress, we'll be going deeper into what is accumulation and their associated parts being type 1, 2, 3, 4, and then also the same with distribution, type 1, 2, 3, 4, and then going into reaccumulation and redistribution. So I want to make this like a standpoint for everybody, or a point of reference. So if you want to learn a little bit about Wyckoff theory, here's the point to be interested in, and then later on would be the boot camps. So I want to give a few prerequisites for expectation management, or a bit of a preface of what we are to expect from this series. First of all, Wyckoff theory is by no means a holy grail. As we go on into the introduction, you will start to see that Wyckoff theory is a theory, and therefore, as any other theory dictates, it is strategic or probabilistic, as we mentioned in our previous video of what is strategy versus fact. However, I do feel like there is certain merit to Wyckoff theory. However, maybe not in the application that Wyckoff theory is supposed to be understood and supposed to be taught. And I believe that is the case with any theory. For example, Elliott wave, the theory as a standalone maybe does not have as much merit, but certain people find profitability or understanding within that theory when they apply it correctly. So the same goes for Wyckoff theory. I think it's some sort of cognitive dissonance where people have certain expectations or strong beliefs within what they have. For example, they may be using Fibonacci for years and they feel like they have a concrete understanding of what is a Fibonacci, and they have seen it time and time again, maybe some sort of confirmational bias, but they have seen that this works for them. So as they come into this with an open mind and be understanding that this could be something different or something that you could use in the future, but also realize this is not a holy grail, or what I start to notice more in the industry is that the next best thing. So we know that in this industry, everybody is searching or looking for something that works, jumping from mentorship to mentorship, or what is the new cool thing, or what is around in the industry and what are people utilizing. And I don't want that to be the case for this. I don't want you guys to see, oh, Wyckoff theory is something new and something interesting, and therefore try it out for a few days and then on to the next one. This is not something that is meant to be created for hype or anything of that nature. It is an established theory that has been around for generations, but the understanding is that as a standalone, maybe it's not as beneficial. The way we trade at WWA Trading, it is only maybe 20% of what we do. However, it's still a critical part. As you may have seen, we have posted and demonstrated multiple 1 to 50 risk to reward trades, or 1 to 100, and now even 1 to 200 risk to reward trades, and as so have the students. Our students have replicated similar trades. Now, I would not say this is because of Wyckoff theory, but I do understand and appreciate that Wyckoff theory definitely supplemented. So in this video, you'll get an appreciation for what is Wyckoff theory, and as the series progresses, you'll start to understand where Wyckoff theory lies and where it should be in your strategy. Okay, ladies and gentlemen, so let's get into the presentation. So just to reiterate, this is actually supposed to be quite an introductory series as a whole. We will not go into in-depth as we do in our boot camps, and we will not be telling you the refinements and the ways we apply Wyckoff theory in conjunction with the other theories and concepts we utilize. However, I'll be giving you an encompassing broad outlook on what Wyckoff theory is from the basics perspective. And just so you guys know, the camera's over here. I'm actually looking at my monitor, so excuse me if I don't make eye contact, but yeah, this whole series is designed to be an introductory one. Today's session specifically is an broad outlook on what Wyckoff theory is, and then as the series develops, we will be going into each individual component and breaking it down a little bit, showing you examples on how generic Wyckoff theory will be utilized versus how we have applied it and improved it into how we formulate the WWA model and the WWA strategy utilizing Wyckoff theory. So let's get right into it. Okay, so WWA Trading, Introduction to Wyckoff Theory series. Welcome everyone, and I hope we all find some value. Let's get right into it. So the introduction. So first of all, I want to give you a little bit of a history lesson. It's not the most important or the most interesting, but I do want to give an idea of who the man was behind the theory, Richard Wyckoff. He was around in the 20th century, so quite a while back, and it was a completely different time. What I mean by that is we were not using smartphones, we were not using brokers as the same way we do now, and I could not definitely not have TradingView or MetaTrader open and execute trades via my iPhone. It was a completely different time, and specifically Wyckoff theory was designed to be utilized specifically for stocks, and also it was used in commodities and the bonds market. But as we are transitioning and Forex traders, we are actually taking a leap and utilizing the concepts that he developed generations ago, and specifically for the stock market, and how we are going to apply it to the Forex markets and how it can still be beneficial and completely applicable even today in the Forex markets. So Richard Wyckoff, he was considered one of the 5 titans of technical analysis. I'm sure you recognize some of the names that are here. Charles Dow, the Dow Jones Average Index was named after him, also known as US 30 or the SPX 500. These kind of indexes were named or created by him actually. Second, William Gann, maybe you don't know him, but he created and developed Gann theory, so using market geometry, market angles, and even Gann spirals, etc. Not something I've delved too much into myself, but he was considered another titan. Another one is Ralph Elliott. I'm sure you've all heard of Elliott wave theory, so he termed and coined the technical analysis regarding wave theory. And Charles Merrill, he was actually the founder or co-founder of Merrill Lynch. So Richard Wyckoff was actually one of these 5 titans of technical analysis. Richard Wyckoff himself also was a very wealthy and successful trader. And yeah, he did actually start his trading career and then went on to more into philanthropy. And yeah, he actually founded the Stock Market Institute school, and he became an educator. And as I mentioned earlier, educating in the stock market, commodities market, and bonds market. He also founded and wrote the Wall Street magazine for around 20 years. So Wyckoff theory has 3 main laws. If you are to read around in the literature about Wyckoff theory, you will find in all resources, you will find these 3 Wyckoff laws being applicable. First of all, the law of supply and demand. Second of all, the law of cause and effect. And third of all, the law of effort versus result. So I'm going to go into each one very briefly. First of all, the law of supply and demand. So this is the most rudimentary principle of the financial markets, and actually it's economics 101. I'm sure all we know about supply and demand and market equilibrium and how price equilibrates and how price finds equilibrium. Put briefly, when demand is greater than supply, price rises. When supply is greater than demand, price drops. And when demand equals supply, the market is considered in equilibrium and you'll have low volatility. So yeah, this is actually a very simple concept, and I'm sure we've all come across it before. And yeah, this is actually when you get typical price action traders, this is what they are trading, with supply and demand zones, and more so the interaction of how supply and demand are interacting with each other. This is something that is actually quite a critical component when I come onto the composite operator. The idea or concept of supply and demand does become quite critical when it comes to Wyckoff theory. The second law is the law of cause and effect. So the law of cause and effect is another quite simple one. It's something that is quite encompassing, and you can go into a lot of detail, and is actually the core of what I consider Wyckoff theory. But put very briefly, is simply when you get periods of consolidation, this is not something that is random in the market. You get to consider choppy price action, or maybe you're considering prices not really doing anything, but this is actually the most critical point in price. And why is it so critical and important is because if you are able to correctly identify these zones of consolidation and the intention behind it, and who is in control between buyers and sellers, supply and demand, if you are able to correctly identify who is the composite operator, who is in control, then you can actually capitalize on a trade pre-expansion. So before you reach that trending market, when you're in that consolidated phase, you can actually find a directional bias and trade with the institutions, or more so with the composite operator, and therefore that's how you are able to maximize on risk to reward. As opposed to catching intraday setups, you can actually get, or even swing setups, you can actually catch entire swing or position trades, and that's how you can capitalize and maximize your risk to reward. So put very briefly, at the bottom of a downtrend, you will have a consolidation, and that could lead to a reversal. That consolidation phase, and that leads to that uptrend or reversal, or also termed expansion, is known as accumulation. Conversely, if you are in an uptrend and you reach the top of the uptrend and you have a consolidation and then a preceding downtrend, that reversal that downtrend reversal was caused by the distribution which was in a consolidative phase. Furthermore, reaccumulation is a continuation of trend. So you have a bull run, consolidation, and then continuation of that bull run. Just so you can grasp your head around that concept. If you have an expansion and you have a bull run, and then the market reaches a certain resistance point in the market where buyers are exiting the market because they are taking profit. And also sellers are entering the market because now market is at a premium price. Price is actually higher now, and there's more incentive for sellers to enter the market to try and gain profit. So now you have a new interaction between buyers and sellers where buyers are exiting and sellers are entering. Therefore, you have that period of consolidation where you have new orders coming into the market and orders exiting the market. Now realize, when a buyer exits the market, it's not like us when we have a MetaTrader app and we have an agreement with our broker that we can therefore simply exit a trade with our agreement with our broker. When it comes to composite operators or institutions, they physically own the asset class, or they physically own the currency. So if they are trading Euro USD, they physically own the euros, and then when they want to take profit and therefore sell, they have to actually offload those physical orders and become actual sellers. So when a buyer takes profit, they are sellers in the market, and new sellers can be coming into the market. So the market reaches a cap or a resistance point, and for that trend to continue, those selling orders need to be absorbed to have that continuation or expansion. So therefore you need another period of consolidation. And lastly, redistribution, similar concept where you are in a bearish market and then you get new buyers into the market and those buyers are taken out, and then you have that continuation in that bearish trend. And lastly, I want to talk about the law of effort versus result. Again, this is not so much applicable in the Forex markets because, again, Wyckoff theory was specifically designed for stocks. And in stocks, you can actually read raw volume, whereas in Forex, it's a little bit more difficult to get that raw data. For example, if you are on your Oanda feed on TradingView and you look at the volume that TradingView is giving you, you are actually getting the volume from that broker feed. So you are getting Oanda volume. And obviously, because it's a retail broker, you are actually getting retail volume knowledge. So it's a little bit more tricky, and you do need to do a little bit more research to get true volume. Not something I utilize too much heavily. I prefer to utilize raw price action and actually seeing what the candles are telling me and seeing how price action is developing. And I can actually read in the candles what the law of effort versus result is exemplifying. So very briefly, it costs around 10,000 lots worth of trading volume to move the market a single pip. So what can we learn from that? First of all, this whole notion of market manipulation, I'm not so much a believer in that. I more so consider it an excuse where traders, when they don't understand why they hit stop loss or why they got taken out and they were correct in their directional bias, it's very easy to blame the market maker. It's very easy to blame the composite operator and say, oh, that was a manipulation. But if you just ponder upon that for a second and think, what does that actually mean? Say, for example, you had a stop loss hunt, quote unquote, of 30 pips. And each pip in the market is 10,000 loss. You can actually see, and for something like Euro USD, it's actually significantly more. So that 30 pips stop loss hunt, quote unquote, cost somebody, some institution somewhere, cost them billions of dollars, or at least hundreds of millions of dollars. That is their, therefore, outlined risk. What is their reward for that outlined risk? It is retail stop losses, if that was their desired intention, to take retail stop losses. Now, if they are risking hundreds of millions or billions of dollars to take retail stop losses, are they making back hundreds of millions or even billions of dollars by taking out retail trader stop losses? Realize that the average retail trader is doing 0.01 lot sizes up to maybe 5 lots. That's the average retail trader. And the retail trader that is doing 10 lots to 100 lots, they are less likely to be caught out by a manipulation spike because they actually know what they're doing. So the reward for an institution to do a stop loss hunt is actually negative. It's a negative risk reward. Therefore, just using that logic, that notion that we get manipulated by the market maker is not so evident. However, there is validity or merit into that concept, but completely in a different way, which I'll touch upon at a later time. But what I want you to gain from this slide is that everything in the market is expensive. Each move, each pip in the market costs somebody somewhere a significant amount of money. Therefore, our job as analysts, before traders, as an analyst, is to understand what each move in the market means. I want to understand down to the pip, why did price reverse at a significant point? Why did price consolidate here? Why did price continue and take off from here? All of these things need to be understood. And if you cannot understand the market down to at least a 5 pip range, you do not have enough understanding and precision in the market. Here at WWA Trading, we are taking trades based on the M1 time frame, and our average stop loss on EU is around 3 pips. So, the highest stop loss I'll have on EU is about 7 pips. If it's anything higher than 7 pips, I can refine further. Therefore, in my past, when I was trading retail and I was using trend lines, EMAs and Fibonacci, and my stop loss was 30, 40 pips, that was clearly a lack of understanding of the market. And therefore, to this point, if that 40 pips zone or breathing room that we give is a zone of billions of dollars, and nothing is accidental in there. There is certainly things we can find and certainly concepts we can utilize to actually have understanding of why price is reversing at certain points, or why price is doing certain things at certain areas. Now, when it comes to the law of effort versus result, it's pegged around volume. So what we want to see is when there is certain effort, which can be showcased in volume, do we see the desired result in that? And if we do see that result, that means that the composite operator's effort is being matched in price action. And when the composite operator is putting volume into the market and it is not matched in price action, that is also telling us something else. That means that there is some sort of resistance or counterparty in the market that is actually going against the bias of the composite operator who is putting volume into the market. So as I've written here, for example, when a stock is consolidating but the volume is high, the effort is not reflected in the price action. This is an example of divergence between volume and price action, and that price action that should have led to an expansion is not being reflected, and we are actually getting high effort and low reaction, and that is a sign of something. On the other hand, if we are getting high effort and high outcome, that is something that is in harmony, and that is when the composite operator has achieved their goal. So as I've mentioned a few times now, the composite operator, this is a Wyckoff theory term and something that he termed himself the composite man. So I'll talk briefly about this. So the composite man was an idea or notion that Wyckoff theory has developed and Richard Wyckoff developed himself, and it was more so to get a psychological or tactical edge, to have an idea that instead of multiple parties or multiple institutions, each with various amounts of money, each with various amounts of influence in the market, and all of the complexities that would come with that. Bearing in mind, some institutions might have a desired outcome of 1,000 pip swing, and other institutions might have the same directional bias but only for 100 pips. So you can have weak-handed buyers versus buyers who have longevity in the trade. Now, this adds complexity into that concept, but what Richard Wyckoff what he rather did was he termed all of the buyers in the market, for example. So you can have the composite man for a buyer scenario, you can have a composite man for the seller scenario. So let's talk about the buyer scenario. The composite operator for the buy side, that can be hundreds of institutions doing the same thing at the same time, but with different intentions. But what he did was he collated all of these composite operators, all these operators who are buying, and put them into one single omnipotent player, if you want to, for lack of a better word, put it into a single entity and describe them as one single group or one single party that had the desire to buy. So a bullish composite operator is the multiple institutions who are buying up orders or buying up stock in the market, and the opposing party would be the composite operator or the bearish composite operator whose desired outcome is to have a sell, and therefore they are putting sell orders into the market. Now, when you have a composite operator for the buy side and a composite operator for the sell side, this is disregarding basically retail traders or street money as it's termed, and it's only considering smart money. Therefore, the composite operator can be utilized in conjunction with smart money concepts, where multiple institutions formulate what the composite operator is, and now you have to deem the interactions between the bullish composite operator and the bearish composite operator, and that's where you get the notion of supply versus demand, and that can be reflected obviously very clearly in price action. So I do want to read out this quote from Richard Wyckoff because I do think it is quite enlightening, and it goes like this: all the fluctuations in the market and in all the various stocks should be studied as if they were the result of the operations of one man. Let us call him the composite man, who in theory sits behind the scenes and manipulates the stock to your disadvantage if you do not understand the game as he plays it. And if you do understand it, essentially it is to your profit. So I like this quote, and it goes like this: analogous to a game of chess where the composite operator is the grandmaster who is aware of your next move, and your job as an analyst and a trader is to stay in the game long enough to call checkmate. But essentially what you need to do is, if you can understand what the composite man and the composite operator's outcome is and what they are doing in the meantime, you can actually catch it, and a trader is to stay in the game long enough to call checkmate. But essentially what you need to do is, if you can understand what the composite man and the composite operator's outcome is and what they are doing in the meantime, you can actually catch a ride with them, because these are the people that are in control with the market, and therefore you are trading alongside them. The next, I want to talk about the market cycle from a Wyckoff perspective and how that can be seen in action. So this is the textbook scenario that you will see, and a few key points to mention from this is, first of all, it's rarely going to be as clean as this and as textbook as this. Again, this is a textbook definition, and it is our job to understand the components, understand each section that is going on, and understand the characteristics of each one to therefore capitalize upon them and realize they might not always present in this nice, neat fashion, but they will present very similar, especially if you understand the characteristics, and then you can actually capitalize upon the moves that are happening. Another thing to mention is this is completely fractal. The market moves in a completely fractal way, meaning everything that happens on the monthly time frame will also happen equally on the weekly time frame, down to the daily time frame, down to H4, down to H1, and even down to the M1 time frame, the 1 minute time frame. And therefore we can see these schematics and these market cycles not only happening on a higher time frame, for example the daily, this will actually happen on the 1 minute time frame. Now think about how powerful that is, because if you can understand what the composite operator is doing, the multiple institutions who are leading into a buy, if you can understand what they are doing on the 1 minute time frame, your zone of interest and therefore your zone of invalidation is so minimal, and that's how you are able to have, for example, a 3 pip stop loss, and therefore you do not need to rely on a 50 pip stop loss that other retail traders may be doing. So this market cycle is essentially, as I mentioned earlier, accumulation that we have over here, where we have a preceding downtrend, and then you have this consolidated phase, choppy price action, where essentially what is happening is that the sell or the bearish composite operator, their orders are now exiting the market, and buyers or the bullish composite operator is actually absorbing their orders. They are taking in buy orders into the market, and also another objective is to shake out weak-handed buyers. Think about that. So if you have buyers in the market that are the composite operator, but you also have buyers in the market who are, for example, retail traders, the retail trader might buy over here and want to take profit over here, whereas the composite operator might buy in the same place in the same way, but their objective is to go all the way up here to the swing highs. Now if the retail trader closes out over here right at the end of accumulation on this resistance point, the automatic rally, this now creates inherent resistance for the composite operator. Even though they were a buyer, later on they became a seller and therefore created resistance in the market. So the objective of an accumulation or any schematic is to absorb the orders of the composite operator of the opposing side primarily, and secondarily is parties that are involved in the same directional bias but do not have the same objective. It is to remove them. So the whole idea is that the only party remaining after this consolidated phase is the bullish operator, is the bullish composite operator, and bears or sellers are taken out of the market and weak-handed buyers are taken out of the market. So this is actually a whole process that is taking place, and you can actually see as price action presents, you can actually start to see who is in control. You can actually start to see when the sellers lose control and when the buyers gain control, and when those weak-handed buyers are actually taken out. These can also all be seen in price action, and if you know how to correctly apply price action in conjunction with Wyckoff theory, that becomes a very powerful asset to have. So accumulation is downtrend converted into an uptrend. Reaccumulation is where you have an uptrend which is converted into a continuation in uptrend, and distribution is when you reach the top of an uptrend and that bullish pressure is now converted into a downtrend, and then the redistribution is continuation of that downtrend. So that completes a full market cycle with all the periods of consolidation that can present. So this is an example. It was about a year ago that I found this trade example. It was on a lower time frame, but essentially we can see a complete market cycle. This is very rare to find, but it's something that I did find and I thought it was pretty textbook. And essentially we see a complete market cycle presenting where you get those consolidative phases and then you get the markup or the expansion that leads on from that consolidative phase. That is a sign of a successful, for example, accumulation. If you have a successful accumulation, you will have an expansion that is low resistance. What I mean by low resistance is that expansion was very aggressive. There was minimal consolidation, there was minimal resistance and retracement, and there was minimal sellers in the market. That is the sign of a successful accumulation. So over here we can actually see we had our accumulation. That accumulation led to a reaccumulation, and that reaccumulation led to a bullish push, which then was converted into a distribution. That distribution led to a bearish leg, which was continued in trend due to that redistribution. So a complete market cycle has presented over here. So let's talk about what accumulation is, the first stage that I have shown in that market cycle. So accumulation is when the composite operator is converting supply into demand. So you have that downtrend and that is converted into an uptrend. Those sellers are converted into buyers, or supply is converted into demand. Very simple. The goal is to create a low resistance environment. As is the case with any schematic, in this situation as an accumulation, the goal is to take out sellers and weak-handed buyers to create a low resistance environment, so that when that breakout of the range happens, when price breaches the automatic rally, you have an expansion that is very low in resistance, meaning high in momentum, strong bullish candles with minimal retracements. What you have to realize is that accumulation is technically, if you are buying in an accumulation, you are technically buying in a counter trend way. You are buying in a bearish market. Therefore, you need a lot of confluences and you need quite a good understanding of price action in conjunction with Wyckoff theory to be able to understand how to take these counter trend trades. But realize the power of, if you are correctly executing these trades, you can actually get in on an expansion. And if you are following the whole market cycle, you can actually enter on a trade right at the beginning of a bull run, meaning you catch that entire initial bull run or impulse, and then you get that consolidation, which is the reaccumulation, and then you can catch that second impulse too. And that can actually be broken down in conjunction with wave theory, where you get that 1, 2, 3, 4, 5, where between 2 and 3, that retracement is your consolidation, which can be deemed the reaccumulation phase. So this is actually the textbook example that you will find if you are to Google it or to read around in the literature on the right. This is what an accumulation should look like. You have your preliminary supply, you have your selling climax, your automatic rally, secondary tests in B phase, then you have your spring test, LPS, last point of supply, and then you have your sign of strength. So each of these points have significant meaning, and there's actually certain characteristics. And as this series develops, I'll be doing an entire video on what accumulation is, what each of these points mean, what we should be looking for, what are the characteristics of each of these points, and then I'll be very briefly touching upon how we can utilize this to our advantage and how we can start to formulate a trade idea and generating outlooks, and also start to understand where our entries would be. But briefly, from Wyckoff theory specifically, the way it is taught is you are supposed to enter when the schematic is complete. From a Wyckoff perspective, an accumulation is only defined once it is complete. Therefore, you would be trading in phase E, and therefore your stop loss would need to be at the lows. So phase E would be over here right at the beginning of the expansion. So if you are to enter over here, once you've had a breach of the automatic rally and you've had this fractal reaccumulation happening in the sign of strength area, your stop loss will actually need to be at the lows below the spring. Therefore, if this is an accumulation on the daily time frame, you might have a 100 pip stop loss, which is actually not very tradable. This is not something we would advise. Therefore, if we are to trade Wyckoff theory, we need to be a little bit more intelligent and start to understand where can we see the composite operator gain control, where can we start to see certain market facts, for example, order flow, for example, liquidity plays, for example, structure and the way that it is presenting, and raw price action. When we start to combine these things together, then we can start to formulate a strategy or a trading plan to understand where will our entry criteria be. And certainly you will not have a 100 pip stop loss. The goal is to have always a sub 10 pip stop loss, and ideally a sub 5 pip stop loss, so that if you catch an entire impulse or entire swing that is a bullish expansion, and say for example that is 200 or 300 pips, but you have a 5 pip stop loss, that's how you have that phenomenal risk reward that we catch or that our students also replicate. So first of all, I want to talk about accumulation type 1. I'm not going to be going into the characteristics in this video, as this is just a generic or brief outline video, but this is the most common type and therefore the most readable and most reliable. This is the one you will see presenting most in the market. The characteristic or defining point being the spring. That spring is actually a very critical point, and that is actually where I would consider the transition between the bearish composite operator and the bullish composite operator, and where their dynamic exchange was, and more importantly where those weak-handed buyers were taken out, and where those sellers were induced to come into the market and falsely induced to be in the market and taken out. So there's actually quite a lot happening in phase C where that spring and test happen, and that's where my points of interest will be. So the lower time frame confirmations and refinements will always be important to maximize your return on investment, and therefore we need to actually understand what is going on inside that spring and test area and what the confirmations we will need to justify a high probable, high confluence entry. And considering the higher time frames and structure and supply and demand is actually how you're going to start to categorize where you are starting to see schematics. This is actually an example of a trade we took. This is actually quite well documented upon our Instagram page and also in our Telegram page. This was a trade we gave out live and very, very briefly. This actually demonstrates, first of all, the fractal nature of the market. So on a higher time frame, as we've drawn in this box, you can actually see there is a greater accumulation going on, where you can see phase A, B, C, and D. And within phase C, this is the greater accumulation that you are seeing is actually a type 2, because you see the selling climax, the secondary test, and no spring. But inside that test area, what you can see inside this red box is actually a type 1 accumulation. You're getting the selling climax, the secondary test, you are getting the spring, and then you are getting the test, and you can see how precise our entry is and how minimal that stop loss is. And therefore, if you are entering over here, not only are you catching this internal accumulation and breakout of the range over here, you actually are catching the entire accumulation of the greater range of the type 2 accumulation on the higher time frame, and therefore you are capitalizing on the entire expansion that follows. But for now, as an introductory point of view, certain things I want you to notice. Again, this is not something that we will be trading. This is not something how we will be looking at it. We actually use a lot more intelligent and advanced ways of analyzing, but for a rudimentary or introductory perspective, just look for a rounding off in the market. That's what you'll like to see. You'll start to see sellers losing control and buyers gaining control, and you actually see that developing in price action. And very briefly, you just want to see that rounding off in the market. Next, I want to talk about very quickly is type 2 accumulation. And this type 2 one, the defining feature is that there is no spring. Now, because that spring is at our defining or pivotal point in a schematic, this is actually a little bit more tricky to trade and requires a lot more advanced analyzing and actually a lot more confluences to justify an entry. Because again, we are not just trying to guess and hope for a schematic. We actually need several confirmations to confirm, first of all, it's a schematic, and then second of all, to confirm where is a valid and justified entry. And the idea being, you do not want to be entering again and again and again and taking loss after loss after loss to then eventually catch one trade that is a nice risk reward trade, because that is quite foolish, that is quite naive, and that is quite a beginner way to trade. What you need to have is certain objective, strict criteria, and your strategy should be in a way that you do not need to take 5 losses to catch one single trade. And if you are catching 5 losses, you should actually find a point that is actually invalidating it. So specifically at WWA trading, what we do is we only have 2 points of interest, 2 objective points of interest, and therefore for any given trade we will only take a maximum of 2 losses before we catch the win. And if we encounter a scenario where we've taken 2 losses and a third area is presenting, it will not present for us, because after 2 losses our points of interest have now been invalidated. So that's the objective criteria I'm talking about, where you're using Wyckoff theory, but then you are developing an objective strategy or a trading plan that you can execute in a way that you are trading in a high confidence way. The key for that being, you need to backtest your strategy, stress test it, to know that when it comes to a live chart, you have enough confidence in what you are doing, because you've seen it a million times in your backtesting, and therefore you are trading as your strategy dictates. But in the type 2 schematic situation, the key to this is you need to be monitoring the lower time frames to know when there is not going to be a spring, and therefore you are seeing signs of reversal. You are seeing signs of strength in this LPS area, or essentially a test of the ST. You will be starting to see signs of reversal on the lower time frame, therefore fractal signs of reversal An example of that can be a type 1 accumulation on the lower time frame within that test area of this type 2 schematic, and that would be a sign of reversal, and then you'll need your justification or entry criteria to be presenting also. And again, this is not something we do, this is not something we use, but again, think of it like this. When an institutional trader comes to the market and sees that there is a left shoulder, a head, and then a right shoulder forming, I can guarantee there is no institution on earth that is deciding to enter billions of dollars into the market because of a head and shoulders pattern. That is too rudimentary and too basic. However, we can start to see that, for example, a type 2 schematic does look very analogous to an inverted head and shoulder pattern. That's why you will have situations where an inverted head and shoulder pattern does play out, but it was not because of that head and shoulder pattern. It was actually because of something else, and in this case I would deem it because of a type 2 schematic that was playing out, where the LPS or the test was a test of the head, which is actually the ST, the secondary test. So you can actually start to see the differentiations between the two, but how they, when they are put on top of each other, they can present in a very similar way. So for your very basic understanding, what you can start to do is look for those types of rounding off in the market and start to analyze them a little bit more. Or for type 2 schematics, you could look for examples of head and shoulder patterns and analyze them a little bit more to see, is this actually a schematic playing out? And this is an example of a type 2 accumulation, and this is something I showed in the example earlier. Let me quickly run back to this. So we can start to see, you can deem it as a left shoulder, retracement, head, retracement, right shoulder, and in that right shoulder we actually get a type 1 accumulation. So this inverted head and shoulder pattern is actually my type 2 accumulation, where we have my selling climax, secondary test, and then test without a spring, and then inside my test in that red box I have a type 1 accumulation which does have a spring. So you can start to see the small differences between the two. Very quickly, I want to touch upon is type 3 accumulation. This is not typical, but it's still very tradable, but it will require a lot more analysis. I will be making a whole video on this and be teaching you how certain characteristics that you can start to see and the differentiations that this has from typical type 1 and type 2 schematics. But the key for this is you're looking at momentum, you're looking at price action, you're looking at supply and demand, you're looking at structure, and you're reading into the story that is presenting, and you are starting to build an idea of where sellers are losing control and when buyers are starting to gain control. Again, instead of looking at it for the schematic that it is, for a very basic point of view, just for now, again, when we do a whole video upon this, you will have a greater understanding. But for now, what you can start to see is the market pattern of cup and handle, where you can start to see the rounding off and then a secondary burst or that handle. That is one way on a very rudimentary level that you can start to identify these patterns and then start to delve deeply into them and start to see, okay, these are not market patterns, these are schematics, and you can start to read what that interaction is showing us within that schematic. And the last one I want to talk about is type 4 accumulation. This can be considered very analogous to a descending wedge, where you're getting that compression in the market, or in a retail perspective, you are getting a focal point between two trend lines, and that focal point has a breakout. And then from a retail perspective, you get that break of trend line, break, test, continuation. So you can see you have a trend line over here and you have a trend line over here. You're getting that compression in the market, and then you have that breakout, break, test, continuation. That would be the retail narrative. What I deem it instead is you are getting a compression where you are getting that spring, that pivotal point. That's where the bullish composite operator will enter the market, and then you get that bullish order flow, bullish structure, all of those nice things that we like to see. And again, this is the critical point that we would like to see an entry criteria developing and presenting, especially for the WWA model. This will be a point of interest for us to be confirming an entry point. And again, from a retail perspective, this is not how we trade it at all. I would consider an entry over here upon that test of the trend line a late entry, and a suboptimal entry I would much rather enter a lot earlier on with a lot more confirmation that would be coming in those lower areas. But for now, for your basic learning, you can start to see areas of compression with a break retest of a trend line, and then you can delve deeply into that and start to explore, okay, instead of looking at the trend line, what was actually going on? What was the interaction between buyers and sellers? And as I mentioned in previous videos, start to look for those factual points of the market as opposed to strategic or probabilistic points in the market. Now, very, very quickly, because I have touched upon the accumulation, I will touch upon distribution, but it is very, very similar, just the inverted of an accumulation, but the same characteristics do apply. In a distribution, the composite operator is converting demand into supply. So you're converting a bullish market into a bearish market, or buyers into sellers. Therefore, the composite operator or the composite man is a bearish composite operator or a bearish trader. Their goal is to create a low resistance environment, as was the case with a bullish composite operator in an accumulation. And their objective is to take out weak-handed sellers, and their objective is also to take out the buyers that are in the market. They want to absorb those buy orders. And again, just as the case was with an accumulation, this is actually pre-expansion or pre-trend. Therefore, an entry upon a distribution is therefore considered technically a counter trend trade. Therefore, we need a lot more confirmations and a lot more confluences to have a justified entry upon a distribution or an accumulation. So again, this is a textbook scenario that you will see if you are to research in the literature or online. And this is an example I found. This was actually on USD/JPY back in June of this year, and a trade that is also documented upon our Instagram because it was a trade I had taken. But again, you can see it's quite similar, but the goal of a schematic is not to match it up to a Google Images picture. Our goal is not to find price action and see how closely it looks to a schematic. That is very false trading, and that is actually I'll deem it a trap. You are falling into a narrative that price needs to reflect certain patterns or certain ways or certain geometry. Again, that is not the objective of these schematics. The schematics are showing you certain points and certain characteristics as there is a dynamic exchange between the buying composite operator and the selling composite operator, and these certain points in a schematic, for example a UTAD, that is a certain point in a schematic where there is an exchange between that composite operator for the buy side and the composite operator for the sell side. So our job is not to match it to a Google Images picture, rather our job is to deeply understand what are the interactions within a schematic and start to see how that is developing in real-time price action. So type 1 distribution, very, very similar to type 1 accumulation. But in this sense, instead of having a spring, we do have a UTAD. Upthrust after distribution has a very similar role and a very similar concept behind it. Again, I will make a whole video upon what is distribution, but very, very similar concepts. Again, instead of looking at the schematic for now for your basic learning, just look for that rounding off in the market, and then you can, when you have found those points of interest that are rounding off in the market, you can actually start to dig a little bit deeper and explore what is going on and see if you can actually start to perceive a schematic playing out and start to see those interactions between buyers and sellers in that price action that is developing. This is an example of a trade I had taken, and this was also shown upon my Telegram, and is also shown upon our Instagram feed, and it's quite in depth. There is a full case study, so I would implore all of you to go upon our Instagram and actually have a read of this case study and look at the multiple time frame analysis that has presented. But just to illustrate the power of the trade that can be when you are trading with the composite operator pre-expansion. So in this specific trade, my entry was upon the test of the UTAD. So I was entering over here where you have a test of the UTAD, and therefore my entry is right here, and my stop loss and zone of invalidation is right above the UTAD. So I'm using the schematic as my points of interest, and I'm using my schematic as also my points of invalidation, because if I've had my UTAD, price should never breach that. So I know where my zone of invalidation is, and it is quite objective. So in this case, because I caught a whole expansion with the trade of the distribution, it was over 550 pips, and my risk to reward at the time of this screenshot was a 1-40. So again, very profound, because I was holding a trade for 2 months plus, and I capitalized on quite nice risk to reward, and it maximized at a 1-90. Obviously I took partials and took profit way before that, but if I had capitalized on the entire trade, it would have been a very, very powerful trade with a 1-90 risk reward. In a situation I could have potentially doubled my account with just 1% risk, which is extremely powerful. Type 2 distribution, again, very similar to a type 2 accumulation, where we have no spring, and in this case it would be considered no UTAD, upthrust after distribution. Again, this is something that is not as common and is a lot harder to read, and therefore you need a lot more confirmations and a lot more confluences to justify a highly probable entry. And the key to that will be monitoring the lower time frames in that test or LPSY area, last point of supply. And that is something I will make a video upon, and more so for our students in the boot camps, you will know exactly how to confirm an entry, especially on the type 2 distribution. But just for your understanding for now, you can start to read it as a head and shoulder pattern. Look for those head and shoulder patterns. Again, The head and shoulder pattern does not work because of the pattern that it looks like. It is not because some institution is starting to think, oh, that looks like head and shoulder pattern, therefore that is an entry. That is not the case that is happening. Rather, it is something that looks like a head and shoulder pattern, but if you delve deeply into it, you'll start to see that in fact it is a distribution schematic where that right shoulder is essentially a test upon the UT, the upthrust, and therefore that's why on occasion head and shoulder patterns do work, but it's not because of the pattern, rather it's because of the distribution schematic, specifically type 2, and therefore you can start to use that for your beginner's journey into Wyckoff theory, where you can start to find these head and shoulder patterns and then start to analyze them a little bit more to start to see how was that a distribution schematic, and therefore how you could have refined that entry and maximized on a risk reward trade greater than that of the retail trader that would be trading a head and shoulder pattern based upon a trend line or a Fibonacci or an EMA. Instead of using those confluences, you can actually get a greater risk reward with a similar entry area of the right shoulder, but with a much refined entry, with a much tighter stop loss and with greater precision, and therefore as a result, higher probability, higher risk to reward, and less losses along the way. Type 3 distribution is very similar to type 3 accumulation. Again, I will make a video upon this, but this is something that is quite tricky and quite advanced. But there are certain characteristics that are typical of a type 3, and I will be covering that later on. And lastly, type 4. Type 4 is very similar to type 4 accumulation, where you have that compression, and in this situation it's an ascending wedge where you will have a breakout of this trend line per se, but essentially what you're getting is your UTAD, test, LPSY. You are getting that bearish order flow and bearish structure, but from a retail perspective, you can see a trend line, you get that break of trend line, break, test, which is your entry, and then continuation. So the retail narrative does work on occasion, it does play out, but it's not because of your trend lines and EMAs, rather it's because of some certain underpinnings of the market that have greater weight, and in this situation it is the composite operator who is creating that low resistance environment for a bearish expansion. Here is another example of a trade I took. Again, it has been documented in detail upon our Instagram. It is a full case study. So again, I do implore you to go and have a look at that and start to see how the 4-hour was developing and how the 5-minute and the 1-minute time frame was developing to confirm the entry. But essentially, you are starting to see that compression where you are getting weaker and weaker impulses, where you are getting that rounding off to the high side, and to the low side you are getting that ascending trend line. So again, we are not looking at the trend line, but we are actually seeing that compression. And then when you have that UTAD and then test, within that test area, I'm starting to see what are those lower time frame confirmations. Am I starting to see lower time frame rejection, lower time frame reversal? That justifies an entry for me. And the key being, if I can get a good entry on the lower time frame with a sub 5 pip stop loss, and I am trading with the composite operator for an entire expansion, I will be able to get great risk reward with that trade. And in this specific trade, it was actually a 1-to-100 trade. So I do implore you to go back upon our Instagram and start to see how we caught this entire 1-to-100 trade. Again, if you are risking 1% as I did, and I didn't take any partials in this specific trade, I actually doubled my account with a single trade. And in this situation, because it was on the 4-hour time frame, the expansion itself was quite fast, because it was a low resistance environment, which is actually a key and is actually a characteristic sign of a successful distribution. I caught an entire expansion, and that happened in the space of 2 or 3 days. So again, something I encourage you to go look at. I will make a whole video on distribution, and I will touch upon type 4 distribution, so you'll get a greater example in the future videos to come. Now, very quickly, I want to talk about reaccumulation. So reaccumulation is that bullish market that has that consolidation to have that continuation in trend. So that consolidation that is happening is where those sellers have come into the market, the buyers are taking profit, and therefore you're getting that resistance. But that exchange that is developing, what the composite operator decides is the bullish composite operator is to remain in control. Therefore, they need to absorb the orders of the sellers, and they need to absorb the profit takers of the other buyers that are in the market, and therefore create that low resistance environment to have that bullish expansion proceeding. So very briefly, a bullish market, consolidation, continuation of bullish market. Again, that phase C area where you have that shakeout or spring and then that test, that is that pivotal point, that point of interest that I'll be looking, and I'll be looking at the lower time frames to confirm a high probability entry. Again, we are looking for those lower time frame confirmations to have a high probability setup. Specifically with a reaccumulation, it's a little bit more challenging, but because it is pro trend, it's a little bit more easy to read from a perspective of structure. And because you are not taking a counter trend trade, you are trading with trend, it is actually a little bit more high probability to be doing so, especially if you have an objective rule set to be trading when it comes to a reaccumulation. Again, the idea is not to match a Google Images picture, rather to actually understand the interaction that is unfolding, seeing how price action is developing, and start to layer how structure is interacting with supply and demand zones, see how order flow is presenting, see how momentum is coming into it, see how these various characteristics are combining together to give you that holistic view and create that story. And once you have that story developing, then you look for your criteria for entry. So there is actually a greater skill set to understanding how to trade a schematic, as opposed to just simply looking at a schematic on Google Images and starting to see how that looks like a pattern on TradingView. That is not the goal. You actually need to have a deeper understanding of how price action is presenting. So here is an example of a trade I took on gold, and this was a very interesting trade and a very, very high risk reward trade. But essentially what you can see is we had that reaccumulation play out where you had your preliminary supply, you had your buying climax, you had your automatic rally, you had your secondary test, you had your up thrust, and then you had a break of structure, which showed me my intent, or that optimism from the composite operator that showed me that there was bullish orders in the market post shakeout. Again, that shakeout was my critical point. That shakeout that led to my break of structure was my demand zone, and within that demand zone I have that red box, and inside that red box I witnessed a lower time frame confirmation in the form of a fractal accumulation, which was my added confirmation for an entry. And this is the result. So not only did we get in upon the test, our stop loss did not need to be below the shakeout or below the lows. Rather, we used the fractal accumulation itself as my entry criteria, and therefore my zone of invalidation was within that internal fractal schematic, and therefore that actually increased my risk reward. So again, it's not about just trading the raw schematic itself. Rather, you are combining it with lower time frame refinements, you're combining it with structure, you're combining it with institutional intent, you're combining it with these multiple factors which we talk about in our boot camps, and then that's how you formulate your trading plan, and that's how you get these high probable and very precise trades that lead to these phenomenal risk rewards that we show on a daily occurrence upon our stories. Again, inside that red box I mentioned earlier, on the 1 minute time frame, this is the accumulation schematic that was playing out. So within that demand zone of the shakeout, we had this playing out on the M1 time frame. So you had on the 1 minute time frame, you had your selling climax, you had your automatic rally, you had your secondary test, you had your spring, you had your break of structure, you had a demand zone that was formed post BOS, and within that, the entry criteria for ourselves was a 30-second time frame accumulation. So again, look at the power of this. We are not simply trading a schematic. That is not the key for this. We are not trading Wyckoff theory alone. We are trading it with multiple layers of confluences. So in this trade specifically, we took a higher time frame reaccumulation. We combined it with structure, we combined it with supply and demand zones. Within our demand zones, we used the M1 lower time frame confirmation, which was a fractal accumulation. And then within that fractal accumulation, we found a secondary fractal accumulation, which was on the 30-second time frame. So we had schematic within a schematic within a schematic, which was a 4-hour reaccumulation. Inside that was a 1 minute accumulation inside this red box, and inside that was a 30-second accumulation inside this green box over here. So we can start to see multi-layer confluences, multi-layer concepts, and therefore when you combine them all together, you are getting a very high probable and a high point of interest with high confirmation, and therefore this is how you maximize your risk reward, because my zone of invalidation was therefore only this point of interest, and therefore my stop loss was very, very minimal, and therefore that led to that great expansion with the higher time frame reaccumulation, but with my minimal stop loss led to a profound risk reward trade. So again, it's about combining all of these factors together to have that greater encompassing and holistic strategy or plan, and you're executing your plan that you have confirmed to work through extensive hours in backtesting. So just to finish off, I do want to show you, before we go into the series itself, I do want to touch upon some of the trades that we have taken utilizing Wyckoff theory, just so you can start to understand the power that it holds, and therefore maybe giving you some sort of inspiration to start to learn a little bit more deeply into what Wyckoff theory is. So this trade specifically, GBP NZD, this was actually my first ever 1 to 50 risk reward trade. You risk 1% to make 50%. I showed this and documented this on my public Telegram. So I do encourage you all to go look at that post, because it was an entire case study. But essentially, We had a spring over here, and then we had the test that followed. On the right, you can see my entry on MetaTrader, and it's actually a full documentation upon my Telegram. So we have the analysis, we have the MetaTrader screenshot, and this trade was a 1 to 50 risk reward, and it was achieved in 4 days. So again, there is no need to be holding trades for months and months on end to get these phenomenal risk reward trades. You can actually get these 1 to 50 risk reward trades on an intraday perspective, and this is something that not only I am doing and I am preaching, this is what our community of WWA students is doing on a daily basis. And at the time of this recording, we have upwards of 600 students who are doing similar trades like this on a daily basis. And if you have been following us on Instagram for any amount of time, you have seen this on a daily basis. I'm posting this on our story. On a daily basis, we are seeing students doing 1 to 10, 1 to 20, 1 to 30, 1 to 50, 1 to 80, 1 to 100 trades on a daily basis. The market presents these opportunities every single day, and it is our job as analysts to find these opportunities, and more so find these opportunities that are high probability, high confluence, and high risk reward. Another trade is that UJ trade I mentioned earlier. This was my first 1 to 100 trade. On the right, you can see my MetaTrader entry. Again, there's a full case study and breakdown on my Instagram and on my Telegram, so I do encourage you to go look at that in detail. But essentially, I used a fractal distribution on the lower time frame to confirm my entry, and therefore you can see my entry and stop loss. It was a very, very minimal point of interest, and zone of invalidation was very, very small. And again, in 4 days, I was able to catch a 1 to 100 trade, a very profound trade, and a hallmark trade specifically for me, a very proud moment for me, because this was my first 1 to 100 trade. Next is this GBP USD accumulation. Again, another 1 to 100 risk reward trade, and this was based upon an accumulation. You can start to see you had your spring, you had your test, and again, another fractal confirmation that was required. We were not simply basing our trade upon the higher time frame accumulation that was there. We actually went into the lower time frames to confirm where the rejection was, and this trade was slightly longer. It was 22 days, and at the time of this screenshot on the right, it was a 1 to 100 trade on our MetaTrader. This was another trade. This is a hallmark trade for me because it was my longest trade that I had ever held. This is actually an old screenshot. If you go onto my Instagram, you can actually see the more recent updates. And I held this trade for 4.5 months before I took significant volume off. And it was upwards of 4,500 pips. And you can see that full breakdown again on our Instagram. But again, that was based upon an accumulation with fractal lower time frame confirmations to find that refined point of interest and then have that greater risk reward. But again, you can start to see you had your selling climax, secondary test, spring, lower time frame test, and then entire expansion. So we caught an entire bullish expansion, an entire bullish run from the beginning, and therefore we caught an entire position trade, and that's how you're able to get these phenomenal risk reward trades. So just to summarize, I will be doing a full encompassing series upon Wyckoff theory, and I'll be going into depth into what accumulation is and all of the types that I've covered today, type 1, 2, 3, and 4. And instead of looking at those rounding off cup and handle patterns or head and shoulder patterns, which is very, very basic and very, very rudimentary, I will actually be going a little bit more into depth and showing you what are the characteristics of each schematic, what each of those points mean, and giving you a little bit more value. And hopefully the idea behind this series is that I want this to be a point of reference for everyone. If somebody is interested in Wyckoff theory, please share this video with them, because I want this series to be the hallmark point where people come to learn an introductory point of what is Wyckoff theory, and therefore a point that you can start to get a greater perspective before you go deep into formulating your strategy and reading deeply into the theory and into the literature of what Wyckoff theory is. So just to finish off, I do encourage all of you to go follow myself, my business partners, Wally and Alex. That formula is WWA, Waqar, Wally and Alex. And each of us do have our individual public telegrams, and in there we do post our trades, we do post updates, we do post analysis, we do post on occasion signals. Wiley himself has given a couple of 1 to 100 trade signals, and you can actually go ahead and find them yourselves, and they were called before the fact. So it's not just us making bold and profound claims, it's us actually executing these live and actually calling them live to the public on occasion. So I do encourage you all to go read and backtest all of the trades we have shown, because I do consider it a very powerful resource, because there is, on my side at least, there is trades going back over 1 year. So I have a documentation of over 1 year's worth of trades and the high risk rewards that I have achieved, and therefore that is a very powerful resource for anybody to go and use to their advantage and start to backtest those trades that we have taken and start to understand how we are starting to look at the market, and then trying to trying to catch our market IQ, our market experience, and our market intuition. And therefore that streamlined resource could be of benefit to you. So I do encourage all of you to go follow us on our personal telegrams, and also we do have our WWA trading page. It is at the bottom right of the page. You can see it is at WWA trading. So I do encourage you to go follow us on there, because on there we do post on a daily basis our personal trades, we do post our student trades, and on the feed itself we are posting case studies of certain trades that we have taken that are high risk to reward, that I do feel like are positive educational posts. Therefore each post you can take some value from, because you'll start to see on a multi-time frame basis how we are trading these schematics, for example, and how we are starting to achieve these high risk reward trades. And you can start to look at our case studies, learn from them, and then go ahead and back